So let's look at a practical example of a 35-year-old male making $100,000 a year. If you earn $100,000 annually for the next 30 years, that means $3 million will flow through your personal economy. That's a lot of money when you think about it. A lot of money is going to flow through your hands over the next 30 years. The problem is a lot of it may slip through your fingers. But what if you could secure that $3 million today, guaranteed? Well, you have your $100,000 coming in, as we've discussed, to your bank account. Let's say you're going to invest $10,000, you're going to save $10,000, and the remaining $80,000 you're going to spend. That means $2.4 million is going to permanently leave your personal economy over the next 30 years. It's just slipping through your fingers. What if we could recover even a portion of that? And I'm not suggesting you not spend the money. I'm suggesting you implement the infinite banking concept as a way of recovering it. So what if we could ensure that none of that $3 million is going to leave your personal economy? So secure your future $3 million net worth today. Actualize your potential future $3 million net worth today on a guaranteed basis. So we are going to secure $3 million of convertible term life insurance and gradually make it permanent by converting it to whole life. So this is how we're going to ensure that none of that $3 million is going to leave our personal economy. So what we're going to do at age 35 is we're going to start securing it. And this is just a hypothetical example. But here we'll start with $1.25 million of whole life and $1.75 million of convertible term. Then 3 years later, we'll convert more of it. More of that $3 million becomes permanent. So now we have $2.25 million in permanent death benefit and $750,000 remaining in term. And then by age 41, we've now converted the full $3 million to a permanent death benefit. And because it is permanent, that money can't leave us. It's pretty much guaranteed none of us are getting out of this thing alive. So we know that $3 million death benefit will be paid, unlike with term, where it's very unlikely that money will ever be paid. So we've now locked in our $3 million net worth. Okay, and we'll show how it's going to actually be liquid and accessible to us, so we can actually spend that $3 million while we're alive. We'll show that later. And this is showing annual premiums going into our policy. So starting at age 35, we'll be paying $20,000 annually into our whole life policy because that's the amount of free cash flow we have. Then by age 38, it's now $40,000 when we've taken out our second policy. And then by age 41, we're paying a total of $58,000 into our whole life policies. So over time, the contributions increase. Now it's important to point out that $58,000 is not a cost. None of that money is leaving our personal economy. Quite the reverse. When we pay a premium into our specially designed whole life policy, we are permanently locking that capital inside our personal economy where it can never escape and where it's going to earn for us from now until the day we die. So we should not be afraid of paying too high of a premium into our whole life policies. We should be afraid of paying too low of a premium into our whole life policies because this is how we're going to capture that capital inside our personal economy where it cannot escape. So over time, your $3 million permanent death benefit is going to become liquid in terms of cash value. The cash value grows at a guaranteed rate and can be accessed tax-free. Cash value is the net present value of that future permanent death benefit. Think of cash value like equity buildup in your house. Okay? As you pay into your house, your equity in your house grows, and of course your house continues to grow in value. Same thing here. The amount of that death benefit that is liquid grows over time. And here is the death benefit and cash value growth depicted over the next 30 years. This is how we're going to secure our $3 million and have it liquid and available to us. So death benefit is in blue. Cash value, which is the net present value, the equity position, the liquid amount of that death benefit, is in orange. So here at age 35, we're taking out our first policy for $1.25 million. Then 3 years later, we take out our second policy. That's where that jump up in the death benefit is. And then 3 years after that, we're converting the last of our term to permanent. So now we have all of that $3 million in permanent death benefit. So by age 50, roughly, we have about $1 million in cash value that we accumulated and $3.3 million in death benefit. Notice the death benefit also grows according to the way these policies are structured. Similar to the way the total value of your house grows, just as the equity in your house grows. And you're collecting rental income. We're collecting rental income here by way of a dividend. By retirement age 65, we now have the full $3 million. So the full $3 million that was going to flow through our personal economy, now we have it permanently captured and liquid inside of our system of specially designed whole life policies. And we didn't take on any market risk, and we didn't pay any taxes on that $3 million. We also have now a $5 million permanent death benefit. It's a permanent death benefit, which means it will be paid. Your heirs will receive that money. This little drop in the death benefit you see at the end is where we take what's called a reduced paid up. I'm not going to get into details on that now, but there's a specific reason why we do that. That's a contractually guaranteed right we have, which we can do. So again, the death benefit is permanent, and even the death benefit can be accessed in the case of long-term care or terminal illness, which can be a huge benefit to you in retirement, and especially as you age. The cash value is liquid and can be accessed via policy loans without interrupting the growth in the policy. So when the money here is not locked up in jail, like if you put it in a 401k or even in a savings account or a brokerage account, if you need to access that money, you withdraw it, and then that money's gone. It's not earning for you anymore. Not the case here. This is a two-dimensional asset. You can borrow against it, analogous to the way that real estate investors will borrow against their properties. Meanwhile, the house continues to go up in value, and they keep collecting rental income. Same thing here. We can access the cash value. Meanwhile, the cash and death benefit continue to go up uninterrupted, and we keep collecting that dividend uninterrupted because we didn't withdraw anything, we just borrowed against it. And even better, a policy loan is not a debt. There are no repayment terms on that loan whatsoever. We can borrow out the money, borrow against the policy, and pay it back if, when, and how we please. So it's important to understand the liquidity here is phenomenal. We are not locking our money up in jail as if it was in a 401k or in some other vehicle where it's only a single-use vehicle. You have to leave it there in order for it to earn for you. Not the case here. You can use the capital, and it keeps earning for you at the same time. So you will probably be strategically taking out and repaying policy loans as the need or opportunity arises. Meanwhile, all this cash value and death benefit growth continues uninterrupted. So you actually have more than $3 million in cash benefits. So we've now reached retirement age 65 with $3 million in cash value. Okay. But how much tax-free income can we generate in retirement from $3 million of cash value? Let's take a look at it. So we're 65 years old. We have $3 million in cash value and $5 million in death benefit. We're going to take out $2.5 million of income. So that's about $124,000 a year in tax-free retirement income that we took on no market risk to generate over the next 20 years of retirement. Okay, question. How much is left? We started with $3 million in cash value. We took out $2.5 million. Question. How much money is left? I want you to really think about this. Maybe even pause the video. Think about it. We had $3 million in cash value. We took $2.5 million of total income. how much is left? We started with $3 million in cash value. We took $2.5 million in total income over 20 years. How much cash value and how much of that $5 million death benefit is left? Think about it. All right, and now I'm going to give you the answer. The answer is, after starting with $3 million in cash value and taking $2.5 million in cash benefits, we have $3.5 million in cash value and roughly $4.8 million in death benefit left over. So we started with $3 million. We took $2.5 million in income, and we have $3.5 million left over. So after 20 years of retirement income, we have more in cash value than we started with. How did we do that? How did we do that? This illustrates the power of the infinite banking concept utilizing specially designed cash value life insurance policies. When you have $3 million in cash value in a seasoned, well-structured whole life policy, it is not like having $3 million in any other asset. Because of our ability to strategically borrow against the policy without taking on debt, without interrupting the growth in the policy. So I want you to think about this and hopefully start to grasp the full power of what we just did.